Hey everyone, Kevin Areia with Stanford Mortgage. Here's your mortgage update for the week. We're starting the week with mortgage bonds under a little bit of pressure, and there's one big story I'm continuing to watch: oil. Today marks the official expiration of the 60-day ceasefire between U.S. and Iran. Now, obviously, there has been still some strikes and escalations during that time, but one thing that's been somewhat surprising is that oil has remained fairly contained. West Texas oil is currently around $83 a barrel. For some perspective, we're typically seeing it more around $60 to $75 range over the past few years. That's higher than we like, but considering everything that's happening in the Middle East, it could certainly be worse. So why do I keep talking about oil in mortgage updates? Well, because higher oil prices can eventually mean higher inflation. Oil doesn't just affect what you pay at the gas pump, it affects transportation, shipping, manufacturing, basically the cost of moving goods all over the country. And inflation matters to mortgage rates. So when we're watching what's happening in Iran and in the Strait of Hormuz, we're just watching oil prices. We're watching some things that could ultimately put pressure on mortgage rates. Right now, about 9 million barrels of oil per day are moving through the Strait of Hormuz. Before the war, that number was closer to 20 million. Some of the lost supply is being made up through pipelines and other routes, but we're still estimating a shortfall of about 5.5 million barrels per day. That's a lot of oil. One thing helping it right now is softer demand around the world, especially from China. That's keeping oil from moving even higher. But really, it hasn't been much progress towards ending the conflict, so this is something we're going to continue to watch. For buyers, here's the bigger picture, and I want to keep this in mind for now. We're in the market where rates can shift based upon headline news, inflation data, and global events, sometimes even within the same week. So, if instead of focusing on trying to catch the perfect rate, the more useful approach is to focus on the opportunity in front of you. If you find a home you love, we run the numbers based on today's payment and see if it fits comfortably within your budget and long-term plans. If it does, great. Move forward with confidence. If it doesn't, that's also valuable information and we'll adjust from there. The key is making decision based upon what's real and available right now, not where we hope or think the rates might be in the future. We've got a few key economic reports this week that could move the market. Housing data is on Tuesday, Fed minutes on Wednesday, and jobless claims coming out Thursday. So there's quite a bit of market to digest this week. Between oil and what's happening overseas and the economic data coming out here at home, we could see some movement in mortgage rates. We'll keep watching it, and as always, if you or one of your clients is looking at a property, reach out. I'm happy to run the numbers based on where things are today. Have a fantastic week. Take care.